It feels like everyone, from the talking heads on TV to your brother-in-law, is screaming that a market crash is just around the corner. But the meltdown in April 2025 taught us a wild lesson. Fear is a terrible financial advisor. While most people were panic selling, a small group of investors saw the hidden signals everyone else was missing. That sell-off was one of the worst in years, yet stocks somehow finished the first half of 2025 at a record high. How on earth does that happen? In this video, I'm going to show you exactly what those signals were, the ones that separate the people who lose money from the people who get rich, and how you can use them to turn the next wave of market panic into your biggest opportunity. Let's be real, the noise is deafening. You open your phone, and there's another headline predicting doom. Analysts are warning that a correction is overdue, with some calling for a 30% crash. Gurus are telling you to protect yourself before millions get wiped out. It's enough to make you want to sell everything and stuff your cash under the mattress. And this isn't just a theory. We saw it happen in real time. The April 2025 crash was a perfect storm of fear. On April 2nd, a day the White House dubbed Liberation Day, President Trump announced a new wave of aggressive tariffs, invoking emergency economic powers. He proposed a 10% tariff on all imports and threatened rates as high as 60% on goods from China. The market's reaction was immediate and brutal. The Nasdaq plunged, dropping over 11% in just 2 days and entering bear market territory. The VYX, Wall Street's fear gauge, skyrocketed to its highest level since the 2020 pandemic crash. Investor sentiment polls showed bearishness at a one-year high, with a staggering number of individual investors, well over half, believing the market was headed lower. This is the exact moment where most people lose. The fear gets so overwhelming that they slam the sell button, locking in their losses. They fall into that classic psychological trap, telling themselves, "This time is different." They listen to the noise instead of looking for the signals. But while the masses were panicking, the smart money was looking at a completely different set of data. They understood that what causes a panic and what actually drives the market are two very different things. The panic was about tariffs, but the market's true direction was being decided by forces working completely behind the scenes. So, what were these signals hiding in plain sight? I've broken them down into 3 key lessons from the April 2025 crash that you can use to get ready for the next one. The single biggest mistake investors made in April was watching the White House instead of the Federal Reserve. The tariff announcement was loud and scary, dominating the news, but a quieter, much more powerful force was already in motion. Throughout late 2024 and into 2025, the Fed had been signaling a major policy shift. After a period of aggressive rate hikes, they started cutting interest rates. Then came the big one, Fed Chair Jerome Powell signaled that the central bank would end its quantitative tightening program. Let me translate that from Fed speak into plain English. Quantitative tightening, or QT, is when the Fed sucks money out of the financial system. It's bad for stocks. By signaling an end to QT, the Fed was getting ready to turn the money hose back on. This is called quantitative easing, or QE, and it's basically rocket fuel for the stock market. So, while everyone was freaking out about tariffs potentially slowing the economy, the Fed was literally preparing to inject massive amounts of cash into the system. This is the hidden signal. The catalyst for the crash, the tariffs, was temporary political noise. The underlying foundation, monetary policy, was becoming incredibly strong. The lesson is simple. Always pay more attention to the Fed's money printer than to scary headlines. The flow of money almost always wins. The second hidden signal was the extreme fear itself. As I mentioned, the VIX was spiking and investor sentiment was in the gutter. Historically, when fear hits a level that extreme, it's almost always a powerful buy signal, not a reason to sell. Think about it. If almost everyone who is scared enough to sell has already sold, who's left to push the market lower? At the peak of the panic in April, the percentage of bearish investors was at a yearly high. Yet just a few months later, the S&P 500 had not only recovered but was hitting new all-time highs. This shows a total disconnect between how investors felt and how the market actually behaved. We saw this again in October 2025. Despite extreme fear in the market, stocks barely corrected. This is the sentiment lie. Social media and the news create an echo chamber of anxiety that often has nothing to do with the market's real health. A professional investor understands this. They see widespread panic not as a danger, but as a generational opportunity to buy quality companies at a discount from people making emotional decisions. Market psychology is a dangerous herd mentality, but if you can step outside of it, it becomes your single greatest advantage. The third and final signal everyone missed was the simplest of all. Companies were still making a ton of money. Ultimately, the market is driven by a few key things: interest rates, liquidity, sentiment, and most importantly, corporate earnings. Earnings are the fundamental backbone of stock prices. Throughout 2024 and 2025, despite all the worries about a slowing economy, corporate profits stayed surprisingly strong, especially in tech. The continued rollout of artificial intelligence was driving a productivity boom, and those profits helped put a floor under the market. The bears, screaming about an imminent depression because of tariffs, were ignoring the financial statements. Sure, tariffs created uncertainty, but they didn't magically make profitable companies unprofitable overnight. Strong fundamentals matter. The April 2025 crash was sharp, but it didn't turn into a long-term bear market because the economic engine, corporate earnings, was still humming. This teaches us a crucial lesson. Follow the earnings reports, not the prophets of doom on social media. Over the long run, stock prices follow earnings growth. If companies are consistently making more money, the stock market will eventually go up, regardless of the short-term panic attacks along the way. Okay, so knowing these signals is great, but how do you actually use this to make money? It all comes down to a simple three-step game plan. This isn't about predicting the next crash, it's about being prepared for it. You can't take advantage of a sale if you don't have any money. The single most important thing you can do is consistently build a cash position in your investment account. This is your war chest. When the market panics and prices drop, you need to be ready to deploy that cash. Don't just let dividends pile up. Actively add new cash regularly. This moves you from a position of fear to a position of power. While others are panic selling, you're calmly shopping for bargains. Greed is just as dangerous as fear. One of the best ways to manage it and build your war chest is to systematically trim your winners. Here's a simple rule. When a stock you own goes up by 50% to 100%, sell a piece of it. You don't have to sell the whole thing, but taking some profits off the table does two critical things. First, it turns paper gains into real cash. Second, it lowers your risk. If that stock then tumbles in a correction, you won't feel the pain as much, and you'll have the cash ready to buy back what you just sold at a lower price. This is how you play the long game. Finally, you need a mental shift. A market drop of 10 to 20% is not the end of the world. In fact, it's a normal, healthy part of how markets work. Since the 1980s, the S&P 500 has had a drop of at least 5% in almost every single year. History shows that markets always recover. While every situation is different, the average time to bounce back from a 10 to 20% correction is often just a matter of months. When the panic starts, resist the urge to sell. Instead of staring at the one-day chart and seeing a sea of red, zoom out to the 10-year chart. You'll see a clear and undeniable trend. Up and to the right. Don't let a temporary storm scare you out of a long-term journey to wealth. If you're getting value from this breakdown and you want to finally stop making emotional investment decisions, do me a favor and hit that subscribe button and turn on notifications. My goal is to give you the clarity and confidence to build real wealth, and you won't want to miss what's coming next. So, what do I think about everyone saying a crash is coming? I think they're focusing on the wrong things. They're watching the scary movie on the screen without paying attention to who's running the projector. The April 2025 crash was the ultimate lesson. The trigger was fear and politics, but the outcome was decided by Fed liquidity, rock-bottom sentiment, and strong corporate earnings. Stop obsessing over predicting the next crash. Instead, focus on what you can control. Stack your cash so you're prepared. Trim your winners to manage risk. And remember that market panics are temporary, but growth is for the disciplined. Crises are simply a transfer of wealth from the impatient to the prepared. And after this video, you know how to be one of the prepared.